Good morning. The Bank of Canada has raised rates for a second time by 0.25% this morning. It's the second consecutive hike since the pause that started in January. And with inflation continuing to come down, it's just not playing out as they anticipated. I mean, the drop was more so due to lower than expected fuel prices than due to a drop in core inflation, which is when you strip out food and fuel. Core sitting in the 3.5% to 4% range, and that's not what they want. It was at this point in the year where inflation really started to decelerate. So it's going to make the second half of this year interesting as we're facing easing comps. But the bank expects inflation to settle to 3% for the next year, then slowly drop to 2% in the middle of 2025. So keep in mind, 2% is the target. They're not expecting that until middle of 2025. Take that for what it's worth. GDP growth essentially unchanged, but however, expectations for growth have gone up slightly due to high immigration. I mean, Canada's population grew by 1.2 million as of Q2 over the prior year. 1.2 million new Canadians. I mean, I know it's talked about a lot, but that is a staggering number, and of course is going to contribute to higher inflation. As per the Fraser Institute, I mean, Canada's GDP per person is growing at the slowest rate since the 1930s and the Great Depression. So this isn't a healthy, productivity-driven growth that we're seeing here. On the individual level, we are worse off. We are in a recession. Unemployment has risen to the highest level since February of 2022, and we're coming out of the still lockdowns. Business outlook has fallen to the weakest level since the depth of the pandemic, and the bank sees consumer price gains held up higher by high government spending and strong demand, so new population growth. The question is, with inflation coming down, with unemployment rising, with GDP on a per Canadian basis continuing to be negative, why have we seen two hikes since the pause? I mean, mortgage interest costs account for roughly 1% right now of CPI. So you back that out, inflation's at 2.5%. The bank cannot control immigration. They can't build houses. I mean, if anything, they know that rates at these levels is hurting housing supply because people are hesitant to sell. Developers aren't, starting new projects with all the rate uncertainty and high cost of building right now. The bank's raising today is, a further step in their commitment to crushing the economy and demand. You bring the labor market into balance by causing job losses. Considering the heavy-handed approach we saw when the pandemic hit, urgently dropping rates to historic levels, then the extraordinary move of keeping rates low for far too long as inflation started to uptick above 3-4%, well above their 2% target. Their intention was to let it run hot. Don't forget. And now the extreme level of rate hikes that we've seen and the unusual move of going back to raising after a pause. I mean, can you really envision a scenario where this ends well? I mean, we know where this is going. Everyone knows how much their spending has changed over the last year and a half. And the painful uncertainty is, okay, when are we going to get to that point? And where will rates be when we get there? And we just don't know. What should you do? Well, if you're in a fixed rate mortgage, increase your payment, start putting extra cash towards the mortgage and preparing for higher rates at renewal. You're going to pay down more principal and lessen that payment shock down the road. If you're in a variable rate, I mean, you can lock in, but you're not locking into a rate that's much different from the rate you're in now. And when you lock in, you're taking on a significantly higher penalty risk if you break your mortgage early. You're taking away the ability to benefit when rates do eventually drop. And locking in only really pays off if we continue to see more rate hikes and they don't come down. If you're in a fixed payment variable, know that locking in will raise your monthly payments because it will have to bring your amortization back on track of where it should be. If cash flows is the concern, just raise your payments by enough to continue to pay off some principal and reevaluate when the rate cycle eventually turns. I mean, at renewal, assuming you have enough 20% equity and you qualify, I mean, you do have the option of increasing the amortization back up to 30 years to lessen the payment shock if rates are still elevated. But make no mistake, you can't have the level of debt that we have as a country and the level of rate increases that we've gotten over the last year and a half and squeak out a soft landing and avoid recession. Again, we all know how this is going to end. We are just not there yet. Leading into this meeting, the CIBC economist Andrew Grantham had said that, in their recent report, they think today's hike will prove the last, will prove the peak. Time will tell. With the next Bank of Canada meeting is in September. So if you have any questions or if I can help with anything, please get in touch. But otherwise, you'll see me again in September in a couple months. Talk to you later.